Good morning, everybody. Welcome to the Flow Show, CPI day in the US. And lots for us to get involved in. Morning, Kay. Looking forward to it.
Hey, good morning, Ryan. Good morning, everybody. Yeah, this is what we woke up for this week.
Yeah, I don't know. Is it what we woke up for?
Well,
I could stay in bed till 1:15.
we gotta say something. This week, this is what we woke up for this week. So yeah.
Yeah, that's definitely. It's going to be fun and games. Hopefully we get a big variation in the numbers to give us some moves. But we will talk about that in a short while. Let's get cracking. Right, start with a bit of data in Japan. PPI numbers out overnight. A little on the beat expectations year on year, but not as high as they were previously. 0.3% versus 0.9% prior. Month on month coming in as expected, a positive number versus a negative the prior month. So a little bit less on the year on year, but inflationary pressures still there in the pipe. Japan are apparently going to offer tax breaks for 7% wage hikes, according to Asahi. It's similar to other stories we've heard before about them looking to offer tax breaks if there are higher wages, particularly for small and medium-sized firms. They're going to help them along to get these wage rises coming in the spring. So 7%, a big number over there, huge number over there, if they manage to achieve those sorts of levels. Over to the RBA. She was waffling on about payment systems and whatever last night, but she dropped some hopeful comments for 2024. She said she doesn't think we're falling behind the world on our inflation fight. Thinks we can cool inflation while keeping jobs gains. Said it's been hard. It's been a hard year dealing with inflation and rate rises, and hopes things will get better in 2024. It always fills you with confidence when a central banker is hoping for something. Anyway, bit of good news for Australia. China has apparently lifted its ban on meat shippers with the Aussies. That was as of yesterday. They're going to allow imports of Australian meat produce. Further signs of easing tensions over there, and they'll be looking or hoping again that they will spread to other parts and sectors of the Australian economy. Over to the UK, Jobs Day for what they're worth, given the mess the ONS is making up of producing these numbers recently. The main take to look at, or the main things to look at, is those wage numbers, which a lot of people are saying, oh, it's showing a slowing in inflation and so on and so forth. Okay, wages came down. Wages, including bonuses, came down to 7.2%. From 8%, so much lower than expected. Pretty much the same for wages take out bonuses. So there's a few people, as I say, getting a little bit bearish on the UK or UK inflation picture because of those numbers. Make no mistake, these are still very, very hot numbers. Okay, this is something that some in the Bank of England MPC have been commenting on as to why they've been voting for hikes. So we're still seeing a 7 handle on these. I was expecting wages to come down much faster than that, but it still seems there is a lot of wage pressure going on in the UK. This is going to feature in the Bank of England's decision on Thursday. So while they have come down a big chunk, still very hot and still not coming down fast enough. I would imagine for some on the MPC. So I'd expect those votes to still remain there, perhaps for hikes. A lot of people thinking we might go to a 7.2 for hikes from the prior 6.3. I think it might stay at 6.3, but we can get into the Bank of England another time. Over in Sweden, and Riksbank's Bunji says that monetary policy is working and inflation is on its way down. But it is much too early to say we are done fighting inflation. One factor into next policy meeting is what the market is pricing. So a bit of an indicator there, what they're looking at to decide on what they're going to do with rates. Germany, zoo numbers out. Current conditions getting worse, not as worse as last month, but worse than expected. But expectations picked up to 12.8 versus 8.8 expected and 9.8 previously. So things might be looking chipper on the horizon for the Germans. However, one of the reasons, or the main reason why expectations rose, and I'll quote the zoo, it says, "This is due to the fact that the share of respondents expecting interest rate cuts be in the medium term has doubled." So it's not because business is improving or anything like that. It's because they expect rate cuts to help them on their way, which, well, is a bit of another hopium trade we're looking at for that one. So these German lot are hoping that rate cuts are going to help them with their business. We'll see what happens with that. According to the big engineering industry group in Germany, the VDMA, they're not seeing any hopium on the horizon. They now see production declining 4% in 2024. That was versus their previous forecast of only a 2% drop. So in the industrial sector, the VDMA engineering lot are seeing worse production declines in 2024. So they're not looking too optimistic on that one. Over in the US, we had a couple of auctions last night, which were pretty bad. We had the 3-year auction. We should have it on here. I think they put it on here. Let's have a look. There we go. So we had the main one was a 3-year auction that came in with a 1.7 pip tail. Bid to cover was a little low, 2.42 versus 2.67. So that wasn't too good. The yield came in there, as you can see there, 4.49 versus 4.7 previously. There was a bit, dealers took up quite a lot versus what they did usually. But then we had the 10-year, which saw a better bid to cover, 2.53 versus 2.45. So a bit better on that. But again, we saw directs accepting a lot there, indirects not accepting too much over there. Yield went down on that one. The high yield 2.96 versus 2.519 previously. So showing a bit of a difference in the durations there, short end versus the long end. It did see yield rally, but that's faded a bit. Kay, what did you make of that? It was sort of looked like a bad auction, but not a bad.
Yeah, it looks as if bid got stuck with the primary dealers or so, but yeah, it's a bit of a strange reaction in the yields. And then I was looking back at what we saw on the numbers, and especially we had around the time or just before the time of the first auction, we had those US inflation expectations out, which were coming down. And well, perhaps I don't know exactly until what moment people can put in bids for those auctions, but perhaps it's just a delayed reaction, you know, on the interest rate front. I haven't seen really something in the treasury auctions to have the yields come back down, unless those bond sharks were just keeping them up a little bit, making the treasury pay, and then say like, okay, I mean that's enough. We had our moment of fun, and then going back to those consumer inflation expectations, which in the short term, the New York Fed expectations have come down relatively sharply prior to the other one, which they're now running at 3.36% from 3.60 before. That is one thing, perhaps that caused this delay in response in the bond market.
Yeah, very much so.
I haven't seen anything else that really justifies why yields were coming down right after the right after the auction.
No, we did. They were moving higher there. As you can see, that's come down as well, which in part has probably done a lot for why dolly end's a bit lower today as well. Yeah, it's the market's doing a lot of pushing and pulling around. You know, not doesn't want to put too much risk on the table ahead of these data and the Fed and everything. So we're probably going to expect a few moves like this that don't make too much sense, but. We can't get into the minds of some of these people trading it. So markets are going to do what markets are going to do. One other small headline I've got from the US, just another one on the jobs front. Hasbro are now cutting 1,100 jobs, they say, because they've seen sluggish toy sales persisting into the holidays. Not something a company like that wants to see coming into Christmas. Might be usually one of their strongest periods. So that suggests potential issues for consumers, maybe not spending as much, or they've had a decent sales period, November, and that's going to fall off a cliff in December. Also, maybe the price of things as well impacting, but it's also just another headline about job losses that we've been keeping an eye on recently. So we shall see how that turns out. That's it. Bit of a quiet one. Kay, you got anything you've spotted, you've spied?
Sorry, no. Yeah, well, the one thing is that you know, we had this vote in the Japanese diet about the no confidence motion against Matsuno, but that he survived it. So business as usual. But then I saw Kishida is supposed to talk tomorrow in Parliament. So in the mix of everything else, there we may hear a little bit more from Kishida, perhaps some more reshuffling of the cabinet or so. I don't think it had a big impact on the yen, but it's just something that's going on over there, which can just before the Bank of Japan cast a little bit of a shadow over what's going to happen for the Bank of Japan if they don't do too much, let's say.
Yeah.
And I've got one last one, but it's just an opinion piece because it may be important for the FOMC tomorrow, and I may forget to talk about it tomorrow, is that we start to have expectations about the halting of the, or at least the serious tapering of the QT. And that is now expected around June. If that would be the case, that would go a bit against what Powell was saying up to now, saying that QT could still be running in the background, even if they start to cut rates, actually. So that is something perhaps to one of those questions could pop up tomorrow on the FOMC. So that is one perhaps to keep in mind, more than talk about rate cuts, perhaps, is how they are going to handle the QT, because the reserves are coming down rapidly. The RRP really has come down to levels where we are not too far away from levels where otherwise the Fed could actually stop QT in another time. They have done it. So that may be something that we need to keep in mind for tomorrow's FOMC, if that question pops up, to see what Powell wants to do or reply to it, because obviously QT is affecting liquidity conditions, right?
Yeah, it's a bit of a strange one, because it's almost as if people are saying, you know, they might halt QT while they cut rates, almost as if it's an easing measure. They've got no reason to ease. You know,
No.
the Fed cutting rates, okay, it isn't easing, okay, in the general sense. They're not cutting rates to stimulate the economy, which is what would happen normally. They're cutting rates to get them from high levels down to neutral levels. So the market seems to think that the Fed cutting means we're going to zero, QE is going to start up again, and all the rest of it, like it was in the last 10 years. That's not the case. Unless the economy falls out of bed, that's not going to happen. This is not easing to stimulate. This is getting rates down to a neutral level. And it seems like a lot of the market is thinking that this is an easing cycle to stimulate. And it's wrong, quite frankly. I'll go as far as to say it's blatantly wrong if that's what it's thinking. So I think if there's any question like that, Power will push against it. They can still do QT because the end game is to get everything off the balance sheet, reduce the balance sheet. And the only way they'll pause, stop, or lessen QT is if there's financial instability issues arising from liquidity and things like that. That's the only way they'll do it, not because they need to ease and provide liquidity to stimulate the economy. So it's worth making that definition clear to people, what this rate cut cycle is really all about. And therein might be a trade if the market does get overly dovish about rate cuts. Then that's a potential counter trade if you know what the reasons are why the Fed are cutting rates. But we'll see what the market wants to do with that anyway, and see if it pops up in discussions and the questions tomorrow at the FOMC. Right, so CPI. We had a quick look yesterday. Not much more to look at today, really. We know what's expected. Headline number to come down to 3.1%, the core to stay unchanged. Really, for trading this one, we know the market has taken a dovish slant to things. We know the market's expecting rate cuts. It's been ramping up its rate cut expectations, pulling them forward, so on and so forth. We've had a bit of a cooling of those jets after the NFP and the Michigan data and whatever. So the market is a little bit more balanced now, but it's still going to make a move if these numbers show a big variation anyway. If we see the core coming down significantly, that's probably going to be one of the big ones to watch. And maybe if CPI prints with a 2 handle, then the market is going to go off and running with its rate cut trading once again. If the numbers are hot, if let's say we see 4.1, 4.2, 4.3 on the core, maybe something above 3.2 in the headline, then all the hawks are going to come in, and everyone's going to be expecting Powell to be more hawkish tomorrow. They're not going to drop the rate cut bone, even if that happens. So again, likely on a hawkish Powell, we get a rally in yields, we get a rally in the dollar, but then the market will come right back in at some point and start selling the dollar again on rate cut thoughts. So this dovishness isn't going to go away. The market is always far more dovish than it is hawkish. We saw that all the way through the rate cut cycle. Beginning of 2023, we had the pivoters coming in trying to play rate cuts, and they got taken to the cleaners. So however hawkish these numbers look, however hawkish Powell is, it's not going to be enough for the doves. So you might get a few sessions of higher dollar, high yields, but then we're probably still in rally sell mode. What are you looking for in the CPI today, mate?
Yeah, pretty much the same, but I've got the impression that we're already anticipating the whole thing. So the rally selling dollars could become a deep buying. But yeah, the market is clearly looking for numbers to be right. And so I do think that if we get a sticky one, some of them may need to rethink again in the short end. But whatever happens on those numbers today, unless they really crap the bed, and we are on a 2 handle and on a 3 handle in the core clear, I don't think it's going to change an awful lot in the big picture, because we unless huge accidents, we have seen the peak everywhere, and now it's really getting to know whether they are going to cut sooner or rather later. Of course, it's going to have an impact. If you really have a low one, people are really going to get the hammer out and whack the dollar, right? If you get a sticky one, then yeah, maybe a little bit of rethinking again, pushing again the dollar a little bit higher. But if you look at, well, me at least, I may think that perhaps if you look at this whole week of US data and the FOMC, I wonder if the data are not going to be somewhere more important than what the FOMC may give us tomorrow. So yeah, there is going to be quite a bit of pushing and pulling, because imagine that we get what the market expects, let's say around here, 3% in the headline, 4 in the core. That's not going to change the idea of we have seen the peak in yields. And then tomorrow, as I said, it's probably going to be a thing about QT or not, rather than anything else. But then afterwards, we are going to get what do we get? We get the PPI, we get the retail sales, we get the PMIs already hitting. So in my mind, I'd see perhaps the data more important than what FOMC is going to give tomorrow.
Yeah, I think the data after, as I said yesterday, is going to be important, just to put the message to the test, whatever comes from the Fed. If the Fed's all bullish and hawkish and whatever, and then tomorrow we get a really shitty retail sales, the market's going to go, well, right, well that commentary hasn't lasted long. Now we're going to hammer you again. So yeah, it is going to be important, the data. But it's all jigsaw pieces. The CPI is one, the Fed's another, the data after is another jigsaw piece, and all we're doing is trying to build a picture up and how to trade it.
Yeah, but the market is in the meantime really looking for reasons to sell dollars. That is clear. I mean, we had this retracement on just to take the euro dollar for instance. We went down to the 50% of that move, and it really comes back higher again every time. It bounces off that level, that 107.30s, and really that still means to me that the market is still looking for reasons to sell dollars. That's clear. So if the data give them those reasons, then they probably will. We may be in for that may be the kickstart for the end of the year in the dollar, if it's really coming in weaker, those data.
Yeah, exactly. And if that makes an interesting trade really, because if the CPI data does come in stronger, and we get another move down to that 107.30s and it holds, that's going to set up your levels really for a run into the FOMC. So yeah, again, you can take several views of how you want to trade this. You can trade the short-term levels in between. We know 108's a bit of a level, 108.30, that sort of thing. If you want to be scalping off the levels, go ahead. Or you take a bit of a back seat, watch the data coming out and see where we close at the end of the week. If we haven't gone through 107.30 after the Fed, all the data, everything else, ECB, that's going to tell you a story. Likewise, if we haven't broken up above any of the higher levels overall, that's going to tell you a story. And that story is that whatever trend we are currently in is likely to continue, or it's going to change. So yeah, two ways to trade all this, depending on your risk parameters and whatnot. So dollar yen has pretty much said moved pretty much in line with what yields have done. We found 146.50, a tough nut on the bounce. It was a prior support area and break point, so no real shock. It's shown up. We're down near 145. I'm going to be watching this to see if that holds. It's obviously a big level that we've been watching that for several months, and watching the price trade around it, trade off it, whatever. I'm still waiting for a rally. I might have to scratch the itch, Kate. I know I've been saying about the carry costs, but if I get a decent rally today, I might just have to put some on and suck it up, and just so I've got some skin in the game. You know what I'm like. I can't be itchy for too long without starting to scratch it. But we'll see what the CPI does. So what I want for that is a hot CPI number.
Yeah, and then let's also not forget if we look a year back. Recall what I said in November 2022 is where the US CPI started to turn around, and that is really what knocked the dollar yen off its pedestal then. So we can't forget that as well. So if we get lower CPIs, that is really affecting the dollar yen. So if you really get those low ones, and then I'm not going to say you don't have to care about your carry, but usually the move will pay for much more than what carry could cost you.
Yeah, that's what I'm thinking. There's enough volatility in this pair at the moment
Yeah,
that you can probably do a bit of jiggling around and pay for your carry cost just by doing a bit of slicing and dicing and adding back and whatever.
yeah.
So that's picking up my mind. What are the options looking like at the moment? Are we looking expensive on the
Expensive,
downside?
expensive.
Yeah, typical.
They're pretty expensive. I was looking at them, but they've gone yeah, quite expensive. If you look at, for instance, where we are now in the 1 month, I'll pop up the screen, okay? When I take
Yeah,
the
yeah,
I'll
cool, mate.
show them when I take the screen later.
Yeah, no worries. Right, so just to look at some of the other pairs, Euro Sterling is back looking a bit stronger. I was thinking we might be on for a bit of a break yesterday. We were knocking around this 85.50 again, and I was thinking, maybe if we nick under there, it's going to hit a few stops. We might see a little push lower, but it held, and now we've bounced somewhat. As mentioned, though, that wage data the market's taking on the bearish side. So that's one of the reasons why the quid's off a bit versus this one. I don't think it makes it right, but markets are going to do what markets are going to do. We have nudged up towards the 86 level, bit of an area towards 86.10. I know K's got one at this 86.12, 13 area, but you can see, it's been a prior on and off support and resistance area, so that's it needs to clear that to get a push up, but otherwise we might be just locked in this range between that 85.50 and 86s ahead of obviously both the ECB and the BOE on Thursday. Oil's had a little bit of a pickup as well. I'm still short a little bit of Brent, but we'll look at US. It broke below the zone I have, 72, 73s. We've got up close to the 72 level, but that's as far as it's gone from now. There's been a couple of OPEC waffly comments, OPEC plus waffly comments, and that they should continue their production cuts into next year to support prices. We'll see what happens. It hasn't supported prices since the last OPEC meeting, as you can see here. But it's moved up. Now, what I want to see from oil, I would like to have seen another test of this low just to see if it holds or not. If I got that and it holds, then that would tell me maybe that's the end of the road for my short looking at Brent. It all moves the same way, just different numbers. But we haven't. So we've got back above the 70 buck mark here. So if we start to see support, which looks like we're just about seeing that. But again, we want to see maybe a proper test. Hold that 71s, then maybe we're going to have a little look at this 72, 73 area back above there. Then the pressure's coming off a little bit from all this selling since the OPEC plus meetings. But as I said, if we had a little test down in here and it held, even getting down to 69 and a half, something like that, that would tell me that a bottom is potentially forming now. It's stopped dropping, and then maybe we get a run higher. But while we're below here, it keeps the bearish pressure on. And wouldn't be surprised to see it lower. That's helping out dollar CAD. Well, a little bit, one could say. It's not doing an awful lot. Waffling around in the middle here. This one's on and off the oil bus a bit at the moment, Kay, isn't it? I don't know what's going on really with this one.
No.
Dollar CAD. It was when the dollar was strengthening a bit yesterday, particularly versus the yen. This one was going down, and now it's sitting here. It's not looking like it wants to push up this morning, but it's not dropping with the rest of the dollars either.
It seems we are trading this American block versus the rest again. If you look at it's very very stable, the dollar Canada, but then you have all those Canada crosses who are moving around a little bit. Yesterday I thought EuroCAD was actually starting to break below 146, and now we are back in the 146.5 area. Now it's a bit of a tough read for me, the Canadian right now. I do think, and I will show, there's a bit of a reason, or at least for me, at least a good tryout to be a bit short still EuroCAD, just in case that the oil stabilizes and goes back up a little bit. And after the Canadian jobs report, the Bank of Canada is already out of the way, and I don't really think that we're going to get a hawkish ECB besides surprises. But yeah, it's very, very stable right now. And if you look at it, it is a bit the American bloc, the near-shoring, the French shoring, all those kind of things are also playing a little bit on the mix. The dollar mix is relatively stable, but the euro mix and mix process are moving around. You see, it does look a little bit like that. And we are cleaning the books as well ahead of the CPI, right? CPI, FOMC, retail sales, you name it, ECB. There's a lot to happen this week. So I guess people are cleaning their books up a little bit, not wanting to have too much positions, at least not the short-term speckies, going into what the kickstart of the week now will be in a few hours.
Yeah, exactly. Right, Dej wants to have a quick look at gold. Always happy to do so. Not doing an awful lot with. I had this old line 86 around the 85, 86 previously. We're knocking around there. It's been a bit wishy-washy of late. Haven't had a move down to the next level, 1960s, which again is just a little on-off area. The bigger zone is down in the 1930s. But as I mentioned previously, if we're holding below sort of 2000, 2010, that formula, I've not even got a line in now. I need to put a line in now. Let's do that now quickly. If I can line it up. Boom. There we go. So that's really a marker, because that was the resistance point before we had all this fun and games here. It was support, then we had the break back under. So for now, it doesn't look like gold wants to go any particular way. So it's probably just waiting, like everyone else is, to get all these risk events out of the way. But if you want to look to trade it, then you're going to be looking at that 2000, 2010 level once again. Downside, as I say, intermediate 1960s, and then the bigger area down at these 1930s. So I'm expecting this to just probably range a bit. It might move on the CPI numbers just based on what the dollar does, etc. So again, if you get a big move there, just watch the levels and see what it wants to do. If it hits any of these levels, can't get through, then you've got a potential counter trade. But Dej, let us know what you're thinking about gold. Sorry, us waffling about it, but we want to hear what you're thinking about it as well. So give us a little bit of insight there. Kate, do you want to take it over?
Yeah, right. Okay, let's have a quick look at those options then. You see, this is what I mean on the yen. Usually, this is like the most frequent trades really in the market between the 1 month and the 3 months really. But one can clearly see that the vols have shot up due to those abrupt moves that we have. We have seen of late, and of course into this whole central bank thing ahead of the Bank of Japan as well. There's always some volatility, but it's quite expensive. You already have to go. You pay a big figure away to have a 146.30 in the 1 month. If you want to buy the top side, and if you want to do the downside, because you still have the forwards against you, you're still paying more than a big figure away if you want to go 142.90, for instance. So it's not going to say it's completely prohibitive, because the yen vols have been higher than this, but there is a lot of event risk in here as well. I don't think it's a good idea unless, of course, you hit the move right on the head. That it is a decent idea to have anything on in options right here and now, because sometimes, once the event risk is gone, those options tend to the vol comes down because you take the event risk out of it, and then all of a sudden it becomes a lot cheaper, So perhaps like have a position and then transform it in an option, maybe a better play if you want to get involved in the yen. One that I find extremely quiet. We know that cable is always a bit more volatile than what the euro dollar is doing, but it's very stable. The option pricing very stable. Usually it's a bit more volatile than the volatility, but it's very stable. So perhaps depending on what happens to the sterling over the Bank of England, over the FOMC, and then the ECB even inside, and then you look at on the side what's happening to risk. Perhaps this is not too bad to give it a little try if one really has a clear direction in mind. So that for the options on the euro dollar, yeah, a bit of event risk, but still not too high. So there is still perhaps something to do if we get a clear idea on what may happen, because we do have all the central banks, but as we said, we also have like a bunch of data out. And yes, the liquidity may start to dry up, but there is volume, and there is a possibility for moves into year end as well. So yeah, some things may look a little bit more interesting than going into yen, for instance. Okay. And then, yeah, looking at those things, let's see what people are. No, nothing special. Okay. Let's look a little bit at the first of all the differentials. Sterling has picked up a little bit, but then a little, and I'm in agreement with Ryan there. I don't think that a move from, of course, it's 0.5, 0.7 lower than the prior, but just this move in those earnings were warranted an over 10 BPs move against the sterling in the differentials. I think this is going to correct itself. Well, depending on the CPI, of course, but if it's only depending on the sterling, this may just auto-correct itself and somewhere more in the middle. But that again shows how the market is thinking about sterling, and how quickly a market can flip around from something that was looking pretty big. Euro sterling, as Ryan already showed, was looking offered, and then we came out this morning and all of a sudden turns around. It's trying to break out of this box, but I would think that a lot of it now is going to be down to people managing the positions before we get into the central banks. Okay, so anything between 86, 86.15, perhaps there's a few stops around here that may even need to be taken out, and then we're back around here. I still agree, as I said as well, I still think as well that sterling may come out of the whole thing a little better than the euro. I'm still not a big fan of the euro. So this one is going to be a nice one to really keep a close eye on going into those meetings, but that's for the day after tomorrow. Horatio, would a number in line with expectations to be supported, perhaps higher for longer, reprice at least one? I don't think that a number in line will have the market reprice that many rate cuts, Horatio. It's unless we come out really above expectations, then they will need to reprice rate cuts, and we know how nervous and how quick the market is to react. But it's going to have to be a number far from expectations to really need to cause the need to reprice 1 or 2 rate cuts, and they've already been repricing a little bit. We are a little bit less than I think it's now closer to 100 points or so than the 125 that they were pricing in before. So I would, my base case is that it's not going to need a big repricing. Okay, of course, unless I'm wrong, and we are going to see a number far from expectations. Okay, on the euro dollar, we're already talking about this 50%. It's putting up a fight, and more than half a decent fight. Okay, and it's also this zone from before, this zone from here. If you look left, this zone has already been acting as support resistance in the past, and it's again there. So it's pretty simple, I would say. Around here, if we get back here and then bounce, you know that the buyers are still there. If we start to get below here and hold, then we're probably on our way to test low 106s. On the top side, I think it's around here. These prior lows, here the low, here we have already done. So this 108.30 is going to be my level, really. Starts to break above and go, then, as I said, that would mean that the CPI is really weaker. And even before the FOMC, I would say that perhaps this could be the start of our year-end rally, perhaps. So I'm going to keep a very close eye on what's happening around 108.30, 35. I'm going to get back to this Aussie and this Kiwi. Last week we bounced off this 65 and a quarter again. Now we went down to 65 and a half, and we bounced. It does mean that people don't really want to be short there. So we're gonna need to break this and hold below for the Aussie dollar to accelerate back to the downside. First of all, 64.80, but this line may be a bit fragile. Because really, if we get under 65 and a quarter, keep it under 65 and a quarter, ideally on a close of the day or so, then we may see it lower again. But if we start to get or if we get weaker CPI, if we get those data to continue or to show weakness, I do think that there's a bit of we're going to have to monitor very, very closely what's happening between 66 and a half and that 66.70 again on the Aussie dollar. It's a level that really is intriguing to me, because if it can go, then I think there may be quite a bit of room to get up there. So it's still one of the dollar pairs that I would that are really on my radar if the dollar starts to weaken. Kiwi may be the other one. 62.10, 62.30. We're 70, 80 points away. But on a much weaker CPI in the States, this could really be retested pretty heavily again. Okay, so this may be another one that is ready for a break if it goes. Okay, if it goes, if the CPI continues to be sticky, if tomorrow FOMC Powell is not giving an inch, then we're likely in for a retest of the 60.5. Okay, but these are just the dollar pairs that I'm looking at in case we get this weakness. And in case we are looking at the other side, although we had slightly better data out this morning, also the gold production went up a little bit in South Africa. Mining production also went up a bit in South Africa, so it's doing a little bit better. And we capped around here, right? But in case the dollar would be strong going forward, coming out of this week, whatever, this may be a candidate for the other side to have this final rush higher. Okay, so this is going to be one that I'm going to watch relatively closely in case the dollar starts to push up. Gold, silver, no change for me compared to what's happened yesterday. Still looking at the same levels. Ryan, you covered the dollar yen, and I think this is it. People are watching. Oh yeah, we have Norges Bank as well coming up this week, but it's also on Thursday, right?
I think so. I have to check. Yeah, let's have a look.
Just looking at the calendar at the same time. Yeah, I don't see it on Wednesday. It's on Thursday. So okay, we'll talk about that tomorrow then on the Norwegian Krone. We'll talk about it tomorrow.
Cool.
There's some decent levels there, just around 11, and it's fading there up there a bit. It's going to be decent levels up there as well in case the dollar picks up again. We're gonna have to be very careful up there. And with that, Ryan, I pass it back over to you.
Thank you, mate. I'm just going to grab it back quickly, just to add to what you were saying about to Horatio about the CPI. Can you see my screen okay?
Yeah.
So it's really, I think it's a bit of a washing machine. What happens if it's close to expectations? Like we're expecting 3.1 in the headline from 3.2. If it comes in 3.1, 3.0. There's two trains of thought. You'll have the doves who think, yeah, inflation is still coming down, so we can carry on pricing cuts. But then you'll get the other side, the hawk, saying, well, it's not coming down fast enough, so that's going to mean Powell's hawkish. So it's going to be a bit of a washing machine if it comes in around the expectations. But what you want to do is look at the trend. Here's the ECB or the Eurozone inflation. 2.4%. It went from 4.3 to 2.4 in 2 months. Okay, that's not sticky inflation anymore. US, this is sticky, where we had that low, then it bounced, and now it's only starting to edge lower. So a small number lower keeps the stickiness in US inflation, and that's what the Fed will be worried about. So Eurozone, they're in danger of just keep on dropping out of bed through their target and goodness knows where. So sticky is not what we are for the Eurozone. Sticky is what we are for the US. So that's the narrative you really want to be trading with this CPI data and what the market wants as well. Anyway, enough of the talking. It's down to the action, and there's nothing we can do, say, trade, whatever, to change what's going to drop from those numbers when they drop. So we'll all be reacting to it as we see them. We'll be having that covered, no doubt, live on Face. So make sure you join us there for that one. And we shall see what the trades are and what the numbers are going to do. Thank you very much, everybody. We'll go over what happened tomorrow, as usual, and plan for the next thing coming up, the FOMC. Thanks, Kate, for all your input and insight. And have a great day, everyone. We'll see you tomorrow.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.